Brad Friedlander. After all that hand-wringing, the Fed left rates unchanged last week. So what happens next? Do they move in October, December? Do they just stay data dependent? You tell me.
Well, there's a good chance that they will move, most likely in December, I think, Greg. A lot of speculation out there. Certainly, I wish they had moved last week. It would have ended a lot of the uncertainty that's out there. So I think we are going to be in a holding pattern here for the next couple of months. A bit unnecessary, but I think towards the end of the year we will have liftoff.
And should we be watching China? Because now the Chinese volatility, their stock market, is weighing in on the Fed's mind. So this throws a different wrench into the problem.
It's yet another variable being added into the mix. I think China is something that we do need to keep an eye on, of course, but the situation and the circumstances surrounding China existed months ago, existed a year ago. So really, that's not going to change either within the next few months anyway. Also, the impact to the U.S. is not that significant either as far as exports are concerned. So my feelings around China are that there are going to be a million other Chinas out there. Let's continue to keep focused on the Fed's original mandates, and I think most economists are seeing that as well.
All right, well, with all this in mind, how do you manage the Angel Oak multi-strategy fund? Does what they're doing affect what you're doing?
Well, I mean, it's nice to have passionate views and have a view on interest rates, a view on the Fed. I'm as passionate as anyone surrounding that, but as far as managing a strategy, it's nice to actually be indifferent, and that's the position that we've put ourselves in. We focus mostly on floating rate assets. That's the key in the world of fixed income right now. I don't want to be lulled or trapped into the idea of extending maturities out right now. Of all times, now is not the time to be sucked into that. So we like floating rate assets, but taking a bit of credit risk.
And non-agency mortgage-backed bonds take about 40% of that particular fund of yours. Why do you like them? Is this a play on the housing market? We got some good numbers from Lennar. Is that factoring into it?
That's a bit of a combination. That's exactly right. We had Lennar, KB will be out this week as well. So you are continuing to see that momentum. I was talking to a friend earlier about this movement that we're seeing in pockets of the country from the northeast southward. We're seeing a lot of potential from a housing standpoint. Delinquencies are down considerably. Home prices are up. I think this is going to be a prolonged housing cycle. We want to be behind that and with that. So a combination of floating rate assets, tie that with the housing credits.
And what kind of a yield pickup do you get on the non-agencies? Why not just buy some Fannies and Freddies and have the government back you?
Well, there's a nice pickup there. It's a couple of hundred basis points at least typically. So you're talking about at least another 200%, 2% in yield. So that's one of the keys. On top of that, you don't have prepayment risk. You don't have duration risk that you typically would have, typically because these assets are trading and are priced still at a discount. So you're in a unique position, and I think there are so few places within fixed income to position oneself right now as we're looking to a Fed that's going to be eventually less accommodative than they are right now.
Can you talk about the rise of these so-called unconstrained bond funds? Because it's so hard to find yield, bond fund managers want to go anywhere, they want to invest in anything. Talk about the upside and the downside to that.
Absolutely. I mean, you want to give a manager as much flexibility as possible to be nimble. I think some of the things to be careful of when you're looking at strategies like unconstrained strategies is, do they begin to mimic, simply because of their sheer size, some of the more conservative strategies that they manage alongside of that. So I think that's something to be careful of. Heavy amounts of cash that are unutilized as well is something to be careful of as well. And then the key too is interest rate sensitivity. There is a lot of stealth duration in many of the unconstrained strategies that are out there right now that you would have assumed was not there. So as rates climb, you may be in a little bit of a tough spot. So that's something I would be cautious of.
All right, well, thanks a lot, Brad.
Great to see you.
And thank you for watching The Street.